Imagine this. The very institutions meant to stabilize our economies are now teetering on the edge of a crisis. Central banks across the globe, from the mighty Federal Reserve to the European Central Bank, are losing their grip. And it's not just numbers on a screen. This affects every one of us. Inflation is climbing at breakneck speed. Interest rates are squeezing homeowners. Small businesses are struggling to survive, and borrowing costs are skyrocketing. The unthinkable has happened. Central banks are scrambling to find a way out, and with every passing day, the risks grow. The clock is ticking, and so is our future. We're at a turning point. Central banks, institutions designed to provide economic stability and control inflation, are now facing unprecedented pressure. Years of monetary policies, once thought to be the solution, are now part of the problem. Just a few years ago, ultra-low interest rates were meant to boost economic growth, and they did for a while. But today, these very policies have created a dilemma that's putting the entire global financial system at risk. Picture this. Inflation in the U.S. has hit over 8%, the highest level in over 40 years. Your paycheck isn't going as far as it used to, with consumer prices on essentials like food increasing by over 10% year over year, and gasoline prices reaching over $4 per gallon nationwide, some areas even exceeding $6. The Federal Reserve's interest rate hikes, a tool meant to cool down inflation,
50 basis points, the Federal Reserve cutting interest rates by 50 basis points to a new range of 4.75% to 5%. There was one dissent, Fed Governor Michelle Bowman preferring to cut by 25.
Have jumped by over 3% in just a few months, the sharpest increase in decades. And this spike is making it more expensive for Americans to pay off everything from mortgages to credit card debt, which is now at a record high of over $930 billion. But it doesn't stop there. The stock market has seen drastic drops, with the S&P 500 down by more than 20% this year, and pension funds are losing value rapidly. Small businesses are feeling the heat, with 61% reporting a decrease in revenues due to the economic slowdown. Just when it seemed like central banks might have things under control, they're being blindsided by a perfect storm. Global inflation, energy crises, and economic slowdowns in major economies like the U.S. and Europe. So how did we get here? And more importantly, what can we do to navigate these turbulent times? Stick around, because we're about to break down exactly why central banks are in an urgent state of crisis, what led to this mess, and what could happen next. To understand the crisis facing central banks today, we need to look back at the last few decades. Central banks like the Federal Reserve, European Central Bank, and Bank of Japan were established to control inflation, regulate the money supply, and stabilize economies in times of turbulence. For years, their strategies worked, or seemed to. During the 2008 financial crash, central banks stepped in as saviors. Interest rates were slashed to nearly zero, and trillions of dollars were injected into the economy through a process called quantitative easing, effectively printing money to purchase bonds and other assets. This was supposed to jumpstart economic activity and prevent a deeper recession. It worked, but it came at a cost. Fast forward to 2020, the pandemic hits, economies come to a standstill, and central banks once again flood the markets with liquidity. Interest rates hit rock bottom, sometimes even going negative, and money poured into the system like never before. The idea was to stimulate spending, borrowing, and investing to offset the economic damage from the shutdowns. But these actions fueled an already brewing problem: asset bubbles, increased debt levels, and growing wealth inequality. By 2022, the global debt reached a record of over $300 trillion, a staggering 350% of the world's GDP. And with all this cheap money flowing, the prices of assets, from stocks to real estate, exploded. Housing prices in some U.S. cities jumped by over 30% in just 2 years. The stock market saw one of its longest bull runs, reaching record highs, making many investors wealthier. But as it often happens, What goes up must come down. Then came inflation. All this newly created money and low interest rates meant there was more cash chasing fewer goods and services. It wasn't long before prices began to surge, and unlike any time in recent history, central banks found themselves between a rock and a hard place. Keep interest rates low and risk runaway inflation, or raise them and risk a market collapse and recession. So they started to raise interest rates to fight inflation. But there's a problem. When interest rates rise too quickly, it causes a domino effect. Debt becomes more expensive, borrowing slows, consumer spending drops, and suddenly, the very economy they were trying to protect is now under strain. This is the scenario central banks face today, caught in a delicate balancing act, trying to avoid a full-blown economic meltdown. Now that we've seen how central banks got here, let's explore the strategies they're using and why they are failing. The Federal Reserve has been at the forefront, aggressively raising interest rates to battle inflation. Since March, they've raised rates by over 3%, the fastest series of rate hikes since the 1980s. But the Federal Reserve isn't alone. The European Central Bank followed suit with its own rate hikes, and the Bank of England recently raised rates for the 7th time in less than a year. Even the Bank of Japan, which long held negative interest rates, is now signaling a change in its ultra-loose policy. These decisions are meant to cool inflation, but they come at a steep price. Higher interest rates make borrowing more expensive for everyone, from businesses to homeowners. The effect is already being felt. Mortgage rates in the U.S. have soared to over 6%, their highest levels in more than a decade, causing a slowdown in the housing market. New home sales have dropped by nearly 30% compared to last year, and the number of homeowners struggling with their payments is rising. And it's not just housing. Consumer spending, the backbone of the American economy, is starting to falter. Credit card interest rates have climbed above 20%, and as borrowing costs increase, Americans are pulling back on their spending, which makes up nearly 70% of the U.S. GDP. Retail giants like Walmart are reporting reduced sales, as shoppers are buying fewer discretionary items, focusing instead on the essentials. When big names like Walmart show signs of trouble, it's a red flag for the broader economy. And then, there's the issue of global markets. Central banks worldwide are hiking rates almost in unison, leading to heightened volatility in global financial markets. Stock markets are jittery, with the S&P 500 and the Dow experiencing some of their worst months in recent memory. The bond market is also in chaos, as rising rates cause bond prices to plummet, leading to significant losses for pension funds and investors who once relied on bonds as a safe investment. But here's the paradox. Raising interest rates might slow inflation, but it also risks plunging economies into recession. Central banks find themselves trapped, caught between fighting inflation and preventing a potential collapse in economic activity. It's a precarious balancing act, and every decision they make has a profound impact on everyday Americans, from the value of your retirement fund to the price of your next meal. The urgency of the situation is clear, and one wrong move could send shockwaves across the global economy. It's one thing to discuss monetary policy and global markets, but what does this crisis actually mean for everyday Americans, for you, your family, and your financial future? Let's break it down. First, let's talk about savings and pensions. The average American household has seen their retirement accounts hit hard. If you've got a 401k or IRA, you've probably noticed it. The value of your investments has fallen significantly. In fact, 2022 saw retirement funds lose around $3 trillion in value, with the average account down nearly 25%. For those on the brink of retirement, that's a devastating blow, wiping out years of savings and forcing many to reconsider their financial future. The housing market is another area feeling the heat. For the first time in decades, homeowners are seeing the prices of their properties drop after a red-hot market. And if you're looking to buy a home, mortgage rates are higher than they've been in over a decade, now hovering around 6 to 7%, which means higher monthly payments and, ultimately, less affordability. It's no wonder new home sales have slumped by 29% as more and more Americans are priced out of home ownership. And then there's consumer debt. Credit card balances have surpassed $930 billion, a near all-time high. With credit card interest rates now averaging over 20%, Americans are paying more just to maintain their debt. In practical terms, that means more of your paycheck goes to paying off the past rather than saving for the future. And it's not just credit cards. Car loans, student loans, and personal loans are all becoming more expensive as interest rates climb. The cost of living is also taking its toll. Over the past year, prices for groceries are up over 13%, while gas prices, although slightly lower than their peak, are still much higher than they were just a couple of years ago. Everyday expenses are adding up, and families are finding themselves stretched thin. Even big retail companies like Walmart are feeling the pinch, as their customers spend more on essentials and cut back on discretionary purchases. Walmart recently reported that their average customer is buying fewer items, and their sales mix has shifted towards cheaper, more essential goods. When consumers spend less at big retailers, it's a sign of economic stress, and that stress is spreading across the board. Ultimately, this central bank crisis is more than just numbers and policies. It's about real-life challenges. Higher prices, shrinking savings, and the cost of debt are hitting home. And as the world watches central banks struggle to find solutions, one thing is clear. For everyday Americans, the financial pressures are only growing. So, here we are. Central banks, the entities designed to stabilize our economies, are now in the midst of an unprecedented crisis. From the Federal Reserve to the European Central Bank, rate hikes, inflation, and mounting debt have created a storm that's affecting everyone. From families trying to put food on the table to businesses struggling to stay afloat. We've seen how years of low interest rates and quantitative easing laid the groundwork for today's problems. When the 2008 crash happened, central banks rushed to flood the markets with cash. But those very actions created bubbles that are now bursting. The pandemic only made things worse, as even more liquidity was pumped into a faltering economy, bringing us to today, with runaway inflation, soaring interest rates, and a sense of financial uncertainty. What does this mean for you? It means higher living costs, a tough housing market, shrinking savings, and a need for vigilance with your finances. This isn't just about central bank policy. It's about your future, your family, and your security. When we see record-high credit card debt, mortgage rates rising at a speed not seen in decades, and retirement funds losing value, the implications hit close to home. But all is not lost. While the challenges are real, there are steps you can take to navigate these turbulent times. Diversifying your investments, paying down high-interest debt, and keeping a close eye on economic developments are all crucial. Staying informed is more important than ever, and that's exactly why this channel exists. If you found this breakdown helpful, make sure to subscribe to our channel, hit that notification bell, and leave a comment below on how this crisis has affected you. We'll keep bringing you the latest updates on the economy and personal finance tips to help you make the best decisions for your future. Remember, in times like these, knowledge isn't just power, it's survival. Thank you for watching, and until next time, stay informed, stay prepared, and stay financially strong.